Welcome back to this week's episode of the Dynamist podcast. I'm your host, Tim Gurule. I'm a mortgage advisor, investor, and someone who's not afraid to get their boots a little muddy in the world of real estate. And today we're diving into a topic that's confusing for so many people, but it can be an absolute game changer if you use it correctly. And that is the right of you as the borrower to do a construction loan. So specifically, I'm going to break down how I handle and my company and the loan programs that I offer handles a construction project start to finish. Man, this includes the takeout refinance once the home is done, what a one-time or two-time close is, and how to help your clients go from vacant dirt to their dream home. So let's start with segment one. We're going to break this down into some key segments here. So the first segment is, what is a construction loan? So a construction loan is a simple interest-only loan, typically up to a 12-month period, used to fund the building of a brand new home. That means we identify a lot. We have a floor plan that we want to attack or utilize. We have a contractor we want to use, and we go in, we excavate, we pour a foundation, we build from the ground up. So the construction loan covers things like land, it covers your material, your labor, it covers everything, essentially everything that it takes to go from dirt to a finished house. That can even include some soft costs like engineering, excavation, landscaping, planning, all of that stuff. So a construction loan is a short-term loan, meaning it's not meant to be your forever mortgage. And that's where the next part of this transaction comes in, and it's called the takeout loan. So the main thing to realize here, like one of the main themes that we got to wrap our heads around when we're talking about construction loans, is that this is actually two separate transactions that make one final product, one end result. Okay. And the reason that I want to bring this up is because we have to really think about this as two separate transactions that have to be done simultaneously, hand in hand, in order to successfully cross the finish line. And one of the main factors, one of the main reasons why I bring this up is because I get a lot of VA borrowers who want to do a VA construction loan. And let me just tell you right now, it is 100% possible to do a VA construction loan. No doubt about it. All right. But what I'm going to tell you is anytime the government gets their fingers involved in anything, it becomes arduous, it becomes painful, expensive, timelines are drawn out. And so in my experience, I've done a lot of these construction loans. The easiest and most simple way to do these construction loans are to do them with an in-house construction financing program, which is something that I offer. I'm going to talk about that, and then convert it into a VA loan if that's the route you want to go at the end of the transaction. Why this is really important is because if you do a VA construction loan specifically, and I promise we're not going to talk totally about VA construction loans, I just want to touch on this for a minute. Specific construction loan, you have to have a VA approved builder. You have to have a, whole sign off and checklist of items from the VA, and it's arduous. It's a nightmare. Now, the construction loan process, it's the exact same thing for both conventional VA buyers, whoever it is. I'm just bringing up the VA because it's a common asked question. I'm telling you, it's easier to go through an in-house lender with an in-house construction program and convert it to a VA or conventional when you're done. All right. So let's go into segment two. So there's two steps of this process. We have step one is the construction loan. And then after construction is complete, we want to get out of the construction loan and we want to get into a long-term permanent loan. This is our 30-year fixed mortgage. Segment one, the construction loan, is typically interest only. The interest rate tends to be slightly higher. And these draws are paid off of the amount, or your interest payment is based off of the draws that you draw monthly. So, for your first draw, the interest is going to be lower because it's a smaller amount. But with your second draw, it's draw one plus draw two, and that's the interest. And it compounds up to 6 draws. We'll talk about that in a minute. When we get to the takeout loan, it essentially takes the total cost of construction and it washes it into a 30-year program with long-term conventional financing and a way more affordable interest rate. Okay, so the takeout loan, segment two, the takeout loan, it's a refinance loan. You can do this conventional, FHA, VA, or even a non-QM, and you can use it to pay off the construction loan once the home is complete. All right. How I do this is, and why this is really important, is because these are two separate transactions that need to be done at the exact same time. So the first thing that we do is I take you through a standard pre-approval process, and I make sure that you can be pre-approved for the takeout loan at the end of construction, because What happens if you sign up for the construction loan, start construction, and at the end of construction realize you're not going to qualify for the long-term loan? You're in big trouble. So step one is we pre-qualify you on the conventional takeout loan or VA or whatever you want to use. Okay. And then we submit it to underwriting, TBD underwrite, meaning, to be determined underwriting, but it's a full underwrite. Okay. And the reason we do this is so you're not guessing later whether or not you qualify. Okay. The takeout loan is your exit strategy. You're not just funding a build, you're financing the future home here. All right. So let's take a little detour for a second and talk about segment 3, which is why would you even build in the first place? What's the advantage to building new construction versus going and buying an existing home that's on the market, even if it's new construction or maybe old legacy construction? What's the advantage of you building your own home? So before we dive deeper into the mechanics of the loan, let's talk about why someone would want to build in the first place. Because this isn't just about interest rates and draw schedules. It's about vision. It's about lifestyle. And it's about you controlling your housing. So the first reason is customization. When you build, you get exactly what you want. You get your layout, your finishes, the systems, the appliances, the design. It's perfect for, let's say you want to do multi-generational living. You need, want to live with your in-laws and you want some private space or separation, accessibility needs, or any sort of like niche lifestyle or goals you have, like a home gym or an office or an outdoor kitchen. Think about what you would want in your dream house that gives you the ability to create it instead of sacrificing or compromising with what's just on the market. All right. Number 2 is why someone would do this is modern efficiency. New builds meet or exceed today's energy and safety standards. So you'll save money over time with things like better insulation, HVAC, windows, and smart home techs, all right, which will totally lower your utility bills, and you'll have fewer surprises from repairs or, who knows what over time, all right? The third thing is you're going to have lower maintenance costs. So if you have a brand new home, everything's under warranty. That means that there's not going to be any surprise roof leaks or HVAC failures in the first few years, okay? And it buys you peace of mind and predictable costs. The fourth reason why people want to build their own home is equity opportunity. And this is, for me, the big one here. This is what I think is the golden ticket. Obviously, you guys know I look at things through the eyes of an investor. If you buy right and you build smart, your completed home could potentially appraise for far more than it costs to build. Okay. This creates instant built-in equity, especially in a growing or constrained housing market. Meaning, hypothetically, let's say you're all in at the construction cost of 500,000, but the house appraises for 700,000 because it's nice. It's got modern finishes, square footage. You just created $200,000 of wealth generation equity right there. Boom, on the spot. That, I think, is the golden ticket. The fifth reason that you might want to do this is land leverage. So let's say you already own land. You can leverage it as its value is part of your down payment and financing structure. Meaning, like, say you have a piece of land, you own it outright. Well, that reduces the amount of construction loan you need. It can even be used towards leverage of the LTV qualification amount when you're doing a construction loan. All right. It's a super powerful way to unlock debt equity with sitting dirt that you may have in your family. And the reason number 6 is scarcity and demand. All right. In super tight inventory markets, building is sometimes the only way to get into your preferred location. It's also a great strategy for investors looking to create housing in areas where supply can't keep up. So let's say, you're an investor, you're going to build this house, live in it for 2 years, move and defer capital gains, so on and so forth. It's a great way to do that strategy. All right. So when people ask, why would you go through the hassle of building? That's the answer. Control, long-term control and equity and long-term gain, but you get to do it right the right way. You get control over the entire process. So let's shift into segment 4, which is how do these construction loans work? Okay. There's one specific theme in these loans that's called OTC, or the one-time close option. If there's a one-time close option, that means that there's more than a one-time close option, ? That's correct. There's either a one-time or a two-time close option. And I want to talk about what this means, okay? So a one-time close allows the borrowers to close one time and roll all the construction loan into a permanent financing structure, okay? You're still going to need 2 loans, 2 separate loan files, but it simplifies things for the borrower if they qualify. Now, the caveat here is that only borrowers who qualify for conforming or home-ready loans can use the one-time close. You have to update the TBD approval within 60 days of a project completion for the one-time close. So I'll just give a side story really quick. I'm doing a construction loan, 2 construction loans that are non-conventional, and they were not able to do the one-time close. And the reason is we're not using conventional income. What we had to do was what's called a non-QM loan, meaning we had to verify their income based off of bank statement earnings, so not their traditional tax returns or W-2. And on top of that, their bank statement earnings came from stacked Airbnb properties. So up to 3 Airbnb properties per LLC that we then looked at their bank statements for. Because of that, because it was non-QM and higher risk, we had to do 2 separate closings. So we did one closing for the construction loan, and we're going to do a second closing for the takeout permanent loan. There's just extra risk on there. The bank requires that 2-time close option for a non-QM. Why this matters to you, a one-time close or a 2-time close, is you're just saving money on title fees to do a one-time close. So if you qualify, if you're using a conventional loan, it's to your advantage to do that one-time close. So section 5 is, who is this for? All right. So these loans are for borrowers building a primary or second or investment property home with different loan to cost limits. So for example, if you're building a home that you're going to occupy as your primary residence, these construction loans can go up to 90% LTC, or a loan to cost, if you have an above 700 credit score. All right. If you're building a second home, meaning you're not going to occupy it full time, these construction products can go up to 80% loan to cost if you have above a 720 credit score. If you're purchasing an investment property, that's a construction loan, you can go up to 75% loan to cost, meaning you'd have to come with 25% down of the construction cost if your credit score is above 720. And then, of course, if you're doing a jumbo loan, all right, jumbos are also 75% LTC, loan to cost, with a 740 or above credit score. For jumbos, though, you can only occupy it, you can only do it for primary residences here, all right? So one important thing to note is, if you're a general contractor or a builder, you have to have ample experience to be a self-builder, meaning if you want to qualify for one of these construction loans, you can't be an owner builder unless you have ample experience, because the construction department is taking a risk. They're coming out of pocket and funding this construction project for you. And if they're going to take that risk, the trade-off is they want to ensure that you have industry experience and can complete the project instead of digging a big hole in the ground, getting in trouble, and walking away from the project. So if you are a borrower with no construction experience, you have to use a licensed contractor. It's one of the caveats, one of the drawbacks. But however, most people aren't going to build their own house anyways. They're going to hire a contractor. As long as they're licensed and bonded, it's not a big deal. It's not an issue. If you do want to build your own house and you're experienced, then what we would do is just look at your experience level, look at your project completions, and make a determination of whether or not you're able to personally use the construction loan or not. Right. Segment 6, what you're going to need, or the checklist for getting one of these construction loans. So for borrowers, okay, we're going to need full income and asset documents. We're going to need housing plans. So you're going to have to go out and get your plans engineered, your plot plans, your permits, fixed cost construction contract with a draw schedule, meaning we need you to take your plans to a builder, have them estimate what's the cost of construction, because that's what's going to go into our loan amount. And then we need a appraisal showing the as is and after completion value. So what is the appraisal based on what we have right now, the land, the plans, so on and so forth. And then what do we think the value is going to be after we complete the project? For contractors, what we need to see is their license, their insurance, their W-9 form, their budget, their plans, and a builder permit. Segment 7, moving on to segment 7 is what does the draw schedule look like? What do we expect from the draw schedule? A draw is every time we take cash out for a distribution for the continuance of the construction project, we call that a draw. All right. So this loan program has up to 6 draws. There is a potential to have extra draws. There's a small fee. It's like $375 for each draw above 6, but it's broken down into 6 draws. And essentially, the initial draw can be used for things like soft costs. So designs, permits, your land payoff. So if you already own the land, okay. Subsequent draws are based on construction milestones. So your excavation, your slab, your framing, the finishes, the landscape. All right. Draws are managed through what's known as a CFSI. And you get up to 6 included, like we talked about. Each additional draw is at $375 each. Now, inspections are mandatory for every disbursement. So here's what this means. Let's say that you have completed phase 5, you're ready for your 6th draw to move on and continue the project. Before we just wire you money, what happens is we have an inspector go out, they look and they make sure that you have in fact completed the work. This really protects you. Make sure you're not getting ripped off by a general contractor. Let's say that they're like, "Hey, we roughed in, we framed and we roughed in. We're ready for the next draw." Well, if we just wired the money and didn't check, there could just be a dirt hole in the ground and they're just stealing your money and you're screwed because they didn't complete any of the work. So we always require an inspection before a subsequent draw is released. All right. So segment 8 of this is like, what are the timeline and extensions and pitfalls? So typically we like to see a maximum term of up to 12 months. All right. We can allow for up to 2 extensions of 90 days each. The penalty for these extensions is typically a 1% fee per extension. So 1% loan amount fee of the construction loan per extension. All right. Construction can't begin until the loan is funded and recorded. So you cannot start construction, no shovel in the dirt before we close. Now, I don't want to create exceptions to this rule. I will say we're funding a construction loan right now. One of my clients is getting a disbursement. He already started construction. He did the excavation, poured a slab. He had to because his permits were expiring. The bank made a one-time exception for it. Is it possible? Yes. But as a general rule of thumb, don't start any construction until we close. And then once you receive those disbursements, we can go ahead and start construction. And you must keep all documents synced between construction and takeout files. So meaning like anytime that information is updated on your end, obviously we just need to stay in really good communication so I can update the construction department. I can also update the takeout section of, all of this financing so that everything's working together. All right. So why does this matter for agents and investors both? Like, why is this significant? Well, as a mortgage advisor, I love this product because it creates massive opportunities. For buyers, it gives them a path to build instead of just settle. For agents, it's another tool in your tool belt to open up inventory solutions. So, inventory's tight, the market's rough. If you have an understanding of these lending products, it puts you on another level of the ability to offer a product that maybe other people aren't thinking about or looking in that direction of. If you're turning stones over that nobody else is turning, you're inevitably going to find fruit. Okay. You're going to solve problems that other people aren't solving. You're going to make more money. You're going to be seen as an industry leader. Okay. And for investors, it's a strategic play, especially when paired with lot acquisitions or value engineering, et cetera. So I love this construction program. I really, really think that there's a lot of viability and utility for this in the significant forefront for us. Like, there is runway ahead of us to make this opportunity really lucrative. So, if you're ready to build or you have clients asking about new construction, let's talk. Hit me up. I'm happy to walk through each scenario. I have a construction calculator. We can go through and estimate what the loan amounts would be, what the cost of construction would be. I'll walk you through it personally. So send me a message. You can either, message me on Instagram or you can send it to my email at Instagram. I'm at Gurule Tim. You can find me at my email, tgurule@allwestern.com. I can put those links in the show notes below. But don't forget to subscribe, guys. Don't forget to subscribe and leave a review. I do episodes like this to educate and empower you and really help you guys get to the next level of your wealth building journey. And we're just getting started building big things together. So until next time, I will catch you on the flip side. Peace.